Welcome back to the deep dive. Today, we are staring directly into a paradox. A really expensive, pretty confusing digital
He
paradox.
really is, yeah. The definition of a mixed signal.
Right, because, I mean, if you look at the headlines right now for 2026, the cyber landscape sounds absolutely terrifying.
Oh, completely.
We have AI agents just running loose, deep fakes infiltrating everyday Zoom calls, supply chains.
Snapping like dry twigs.
Exactly. Snapping. It feels like the digital Wild West out there, maybe even worse than a few years ago.
In terms of complexity, I mean, it is definitely worse, without a doubt.
But then, and here is the paradox we're talking about, you look at the financial side of things, specifically cyber insurance,
Yep.
and premiums are dropping.
They are.
Rates are down. It is actually cheaper to buy insurance right now than it was 2 years ago.
Which makes no sense to most people.
It makes no sense. So we have to ask the obvious question here. Is the world getting safer, or are we just getting better at ignoring the fire?
That is the multi-billion-dollar question. And the answer is, it's a little uncomfortable.
Okay.
It's a little bit of, we finally learned to lock the doors, and a whole lot of the insurers just change the rules of the game so they don't have to pay out as often.
Okay. So today we are unpacking the state of cyber insurance in 2026. We've pulled from a massive stack of industry reports for this.
Heavy hitters.
Yeah, heavy hitters. Hoyan, Marsh, Chubb, and some really granular resilience experts like Total and Breachcraft.
Really good data in those.
And our mission today is to help you figure out if that insurance policy you're holding is actually a safety net or if it's full of loopholes designed for a 2020 world that simply doesn't exist anymore.
Because we really need to see if your coverage can actually survive the reality of 2026.
Exactly. And before we jump into the numbers, a huge thank you to our sponsors who make this deep dive possible. Look, if you're listening to this and realizing your defenses are a little dusty.
Or totally non-existent.
Right. You need to check out www.cisomarketplace.com. It's the place to find the right vendors to actually fix these problems. And equally important, check www.breached.company to see if your data is already out there floating around.
Which it might be.
We'll talk more about why that matters later, but seriously, those are the tools you need in your back pocket.
Absolutely essential. I mean, knowledge is the only advantage we have left at this point.
Okay, so let's start with the headline news, the buyer's bonanza.
Right.
If I'm a CFO or a CISO shopping for insurance right now, I'm seeing some pretty friendly numbers, right?
You are. It is currently a very buyer-friendly market, which is a massive relief after the really hard market we saw a few years back.
I remember that.
Yeah, it was brutal. But if we look at the data from the Marsh Global Insurance Market Index, rates are actually down about 6% globally.
6%.
Yeah, and the Council of Insurance Agents and Brokers, the CIAB, they saw premiums drop about 2.6% in their Q3 survey.
So 6% might not sound huge to the average person, buying car insurance, but in the corporate insurance world,
That's a significant dip.
huge. Why is this happening? Is it just competition?
Competition is a huge driver. We call it capacity in the industry.
Okay.
There are simply more insurers in the game right now. Capital markets realize cyber is a pretty profitable bet if it's managed right, so more money just flooded in.
Got it. And more supply means prices drop to win your business.
Exactly. Basic economics.
But I assume there is a technological argument here, too. We aren't just getting cheaper insurance because they're more salesmen.
No.
We actually got better at locking the doors, didn't we?
We did.
Yeah.
We really have to give the industry some credit here. I mean, 3 or 4 years ago, basic hygiene was terrible.
People still using password 123?
Exactly. Now, multi-factor authentication, MFA, it's ubiquitous. You almost can't even get a policy without it. Backups are immutable. They're air-gapped. And because of that, claims frequency, which is the actual number of times people call their insurer screaming for help, that dropped significantly in the first half of 2025.
How significantly?
Some carriers reported a 53% drop.
Wow, 53%.
Yeah.
That is massive. So we're actually getting locked out less often.
Correct. But, and there's always a but, when we talk about insurance,
Of course.
while prices are down, insurers have become incredibly picky. They are looking for what they call quality risks.
Quality risks. Okay, that sounds like code for we only want to insure people who probably won't get hacked.
That is exactly what it is. Think of it like a good driver discount, but on steroids.
Okay.
If you have a clean record, a safe car, and you drive carefully, you get the cheap rate. If you're driving a clunker with no brakes,
You don't just pay more.
right, you might get non-renewed. They will simply walk away from you.
So the price drop isn't a signal that the danger has passed for everyone. It's more of a reward for the people who built a bunker.
That's the perfect way to frame it. The gap between the insurable and the uninsurable is growing really fast.
Which brings us to the danger itself. If claims are down, what are the insurers actually afraid of? What is the new monster under the bed in 2026 that keeps the actuaries up at night?
The monster has evolved. It's mutated. I mean, it used to be just about encryption.
Right.
You'd come in on a Monday morning, your screen is red, your files are locked, and you pay a ransom to get the key.
Good old-fashioned ransomware. Simple transaction.
Right. But businesses got smart. We invested in backups. So now, when the hackers say, pay us or we keep your files locked,
Right.
the company says,
Keep them. We'll restore from backup.
exactly, the hackers lost their leverage
So they pivoted.
aggressively. The new shift is entirely toward data theft and extortion. It's not just about locking you out anymore. It's about stealing your secrets and threatening to leak them.
So even if you have backups and can restore your systems perfectly, they still have a gun to your head.
Yep.
Like, pay us or we email your entire customer database to the New York Times.
Precisely. And resilience. One of the key reports we looked at for this deep dive had a staggering stat on this.
What was it?
Data theft extortion-only events. So where they don't even bother encrypting your files.
They just take them.
Right, they just steal them and threaten you.
Yeah.
Those events rose from virtually zero a few years ago to 49% of claims in 2025.
Nearly half of all claims.
Half.
That's a fundamental shift in the entire business model of cybercrime.
It really is.
Yeah.
So ransomware is really a misnomer now. We should be calling it cyber extortion.
Cyber extortion.
Yeah, it's a hostage situation. But the hostage is your intellectual property or your reputation.
And I imagine AI is just pouring gasoline on this fire. We keep hearing about AI on the defense side, but the offense must be loving it.
Oh, it's a massive force multiplier for the bad guys.
Yeah.
We are seeing the rapid rise of agentic AI.
Okay, agentic AI. That sounds like a sci-fi villain. Break that down for us.
Well, in the past, a hack was a human sitting at a keyboard. They run a script, wait, pivot, type a command.
Very manual.
Labor-intensive, yeah. Agentic AI is an autonomous bot. You give it a high-level goal like, get into this network, and it runs its own OODA loop.
OODA loop.
Observe, orient, decide, act. It scans probes, finds a weakness, exploits it, and moves laterally, all at machine speed.
Without a human checking it.
Right. Completely autonomous.
So it's totally scalable. A hacker group can launch, what, 1,000 of these agents against 1,000 different companies simultaneously?
Precision at scale. And it's not just the technical hacking either, it's the social engineering. Deepfakes are a major concern for insurers now.
Oh, I bet.
We're talking about synthetic insider threats. Imagine using a cloned voice of a CFO to call a junior controller and authorize a wire transfer.
And it sounds exactly like them.
Flawless.
I read about data poisoning in the source material, and that one really stuck with me. It feels like a threat vector we haven't even priced in yet.
Oh, data poisoning is fascinating.
Yeah.
And terrifying. Research shows that if you alter just 0.1% of an AI model's training data, you can cause targeted errors.
Yeah, 0.1%, that's a needle in a haystack?
It's nothing. But if you know which 0.1% to poison, you can train an autonomous vehicle's AI to, say, misclassify a stop sign as a speed limit sign.
Oh my God.
Insurers are looking at this and thinking, how do we even underwrite that risk?
Right.
If a company buys an AI model that has been poisoned and it causes a disaster, who pays?
It's a supply chain attack, but on the brain of the software itself.
Exactly.
And it really highlights why you can't just rely on a standard policy from 5 years ago. The threats are completely different.
Completely. Which is why having the right partners is so crucial today. You can't fight agentic AI with a spreadsheet.
Speaking of partners, this is exactly where our sponsors come in. Keeping up with agentic AI and data extortion just isn't a DIY project anymore. That's why we're constantly reminding you about www.CISOmarketplace.com.
It's basically a curated directory for security vendors. If you need to stop data theft or find tools to counter deepfakes, that's where you look.
Because you do not have time to vet 500 vendors yourself.
No one does.
And on the flip side, you need to know if you've already been hit. That's where www.breached.company comes in. It's a simple concept, but so vital. You check to see if your data or your vendor's data is already out there on the dark web.
But you can't defend against a breach you don't even know happened.
Exactly. Okay, so let's pivot to something you just hinted at, vendors. Because in 2026, it seems like your security is only as good as the weakest link in your supply chain.
We call this the CrowdStrike legacy.
Ah, referring to the massive outage back in 2024.
That was the wake-up call. That incident and the CDK Global incident around the same time really woke the insurance industry up to concentration risk.
Concentration risk.
Yeah, we realized that the digital economy isn't a distributed web anymore. It's a funnel. We all rely on a handful of the exact same vendors.
So if one of them trips, we all fall down, like domino.
Like dominoes.
Yeah.
And the stats back this up perfectly. In 2024, third-party involvement accounted for 30% of all data breaches.
30%.
30%. And that was up from 15% the year prior. So the risk effectively doubled in one single year.
So if I'm a business owner, I might have perfect security internally. I've got the moat, the drawbridge, the archers on the tower.
They're fully locked down.
But if I hire a cleaning crew that leaves the back gate open...
You're compromised.
Yeah.
And insurers are terrified of this. They call it systemic risk.
Meaning?
They are terrified of an event where everyone files a claim at the exact same time because a major cloud provider or security vendor goes down.
Oh, because insurance relies on accidents being spread out?
Exactly. Insurance works because accidents are random. If everyone crashes their car on the same day, the insurance company goes bankrupt.
That makes total sense. So how are they reacting? What are they demanding from companies now to mitigate this?
They were demanding continuous monitoring.
Okay.
It used to be that you'd send your vendor a questionnaire once a year. Do you have a firewall, yes or no?
Yeah.
And you just file it away.
The classic check-the-box compliance theater.
Theater is the right word, but that is dead. Insurers now want to see that you are monitoring your vendors in real time.
Wow.
You need to know if their security posture drops on a Tuesday, not find out 6 months later when they inevitably get breached.
There was a quote in the Grant Thornton report we reviewed that summarized this perfectly. Outsourcing services doesn't outsource risk.
That is the mantra for 2026. You can outsource the work, sure, but the liability stays firmly with you.
Now, speaking of liability and things getting messy, we have to talk about the war exclusion.
Oh boy, yes.
This is one of those things that sounds like legal mumbo-jumbo until it costs you $100 million.
This is where it gets really interesting and honestly a little controversial in the industry. We're talking about the Lloyd's of London mandate, specifically LMA 5567.
LMA 5567, catchy.
Rolls right off the tongue.
What does it actually change?
So traditionally, war exclusions in insurance policies relied on attribution. To deny a claim, the insurer had to prove that a specific nation-state, say Russia or China, was behind the attack.
Which is notoriously hard to do in cyber, right? Hackers hide behind proxies. They route traffic through 3 different countries. It's a fog.
Exactly. It was a huge legal gray area. So the new mandate shifts the focus entirely from attribution to impact.
Explain that shift.
Under the new rules, it doesn't matter as much who pulled the trigger. It matters what broke.
Okay.
The exclusion kicks in if an attack causes a major detrimental impact on a state's essential services. Think power grids, financial systems, national healthcare networks.
Well, let's make this practical. Let's say a ransomware gang hits a widget factory in Ohio.
That's covered. It's a standard criminal act against a private business.
Okay. Now let's say that same ransomware gang, using the exact same malware, hits the national power grid and shuts down electricity for 3 states.
That claim might be denied.
Simply because of the impact.
Because it caused a major detrimental impact on the state. The insurer can argue that this is no longer just a regular crime. It's an act of cyber war, or at least a systemic catastrophe that standard insurance just isn't priced to cover.
That is a massive distinction. It means companies need to understand not just their own risk, but whether they are part of that critical infrastructure definition.
Yes.
Because if you are part of the grid, your insurance might have a trapdoor you don't even know about.
And they really need to read the fine print. You need to know if your policy has that specific LMA 5567 language. Don't assume you are covered just because you paid the premium.
Okay, so the risks are high, the exclusions are tricky. But we started this whole episode by saying rates are down.
They are.
If I'm listening to this and I want that preferred pricing, that 6% discount, how do I actually get it? What is the golden ticket to get the insurers to love me?
It comes down to 4 or 5 key things. If you do these, you're in the club. If you don't, you're paying a premium or getting outright denied.
All right, lay them on us. Item number 1.
Framework alignment. You can't just say, we have security. You need to say, we align with NIST or we align with the CIS controls.
So documentation, you have to prove it.
Documentation is king here. Total's report emphasized this heavily. If you can show an insurer that you are at implementation group 2 or 3 of the CIS controls, you are a categorically different risk than a company that just says, we have a firewall.
It's the difference between saying I drive safely and actually handing them your GPS logs.
Exactly. Prove it. Item number 2 is technical but incredibly crucial. Microsegmentation.
Okay, let's unpack that. It's a bit of a buzzword. What does it really mean for insurance?
Think of a submarine. A submarine is built with watertight compartments, right?
Yeah.
If the hull is breached in one section, you seal the door and the rest of the sub stays dry. Well, most corporate networks are open concept. If a hacker gets in the lobby, they can walk right into the bank vault.
But restricted access.
Right. Microsegmentation puts those watertight doors between your servers.
So it stops lateral movement. If a hacker phishes a marketing intern, they can't jump from the intern's laptop over to the financial database.
Zero Networks pointed out in their research that nearly 70% of insurers now look for this specifically.
70%.
Yeah. If you have a flat network where everyone can talk to everyone, you are a high risk.
Got it. Submarine doors. Okay, item 3.
Service accounts. These are the non-human accounts, admin bots, automated backup scripts,
Why do insurers care about those?
because they're the silent killers. They have high privileges, but nobody ever changes their passwords because they're terrified of breaking the script.
Ah, they're the keys left under the doormat.
And the hackers know it.
Yeah.
Insurers want those locked down, rotated, and constantly monitored.
Makes sense. And finally,
Incident response, IR, but not a binder on a shelf from 2019.
right.
It has to be a living plan that actually accounts for supply chain attacks. If a vendor goes down, what do you do? If you can answer that clearly, insurers will trust you.
I notice in the research that companies like Coalition are actually scanning you from the outside before they even give you a quote.
They are. It's called active insurance. They scan your network, look for open ports, look for known vulnerabilities. If you show up with open windows, they won't insure the house.
It's really shifting from just a financial transaction to a technology partnership. They are verifying your security in real time.
Which is better for everyone, really. It forces companies to actually be secure, not just buy a policy that pretends they are.
Before we wrap up, we have to touch on the legal side. The government isn't staying out of this. What's the regulatory temperature in 2026?
It is boiling. The pressure cooker is totally on.
What are the big ones we need to worry about?
The SEC rules are the big one in the U.S. Public companies now have 4 days, 96 hours to disclose a material cyber incident.
4 days! That is nothing. You barely know what happened in 4 days, let alone the full scope.
That's the problem. Determining materiality, does this matter to investors, is a really complex legal question. If you don't have a plan to assess that and file the report in 96 hours, you are in serious trouble.
And what about across the pond?
The EU AI Act. This is huge for anyone doing business in Europe or using AI models. Non-compliance can lead to penalties up to 7% of global revenue.
7% of revenue, not profit. That is a company-ending fine for some people.
It absolutely is. And then back here in the U.S., we're seeing a massive rise in privacy litigation, specifically around pixel tracking and the VPPA, the Video Privacy Protection Act.
This is the website tracking stuff.
Yes. If your website uses tracking pixels like Meta or Google use for ads, and you're sharing video viewing data without explicit consent, you are getting sued.
Wow.
Insurers are actually narrowing their coverage for the wrongful collection of data because these lawsuits are getting so incredibly expensive.
So not only do you have to worry about hackers stealing the data, you have to worry about your own marketing team collecting it the wrong way.
It's a total minefield. You might have insurance for a hack, but not for a lawsuit because you used the wrong cookie.
Man. So what does this all mean? Let's try to summarize this. We're in a buyer's market rates are down 6%. That's the good news.
But threats are up. Ransomware has mutated into cyber extortion. 49% of claims involve data theft, so you need to check if your policy actually covers that.
And supply chain risk is the new sleepless night for CISOs. You are responsible for your vendors, so continuous monitoring is totally non-negotiable.
Plus, you need to watch out for the war exclusion. Make sure you understand the difference between attribution and impact. Don't get caught in the essential services trap.
And to get those good rates, microsegmentation, build those submarine doors, get that NIST alignment, and start locking down those service accounts.
That is the survival checklist for 2026.
I want to leave you, the listener, with a thought. We talked about AI agents today. Autonomous bots that can attack systems 24/7. As AI starts writing its own malware and attacks become fully 100% autonomous, will the concept of insurance as we know it even survive?
That's a really provocative question. Insurance relies on risk being probable but not certain.
Exactly. If the attacks are constant, infinite, and incredibly sophisticated, do we move to a model where you are either completely unhackable or you're uninsurable?
I honestly think that's where we are heading. The gap between the haves and have-nots of cybersecurity is going to widen drastically. If you can't automate your defense, no one is going to sell you a policy.
Something to think about while you're reviewing those policy renewals this year. A final thank you to our sponsors for helping us navigate this mess. Head over to www.cisomarketplace.com for your defense tools and www.breached.company to know your exposure. Check them out.
Highly recommended. They're great resources.
That's it for this deep dive. Stay safe, check your backups, and maybe go read that fine print on your war exclusion clause.
It's definitely worth the read.
See you next time.